All right. Again, thanks for joining the webinar today. My name is Mike Whitbeck. Hey, so we're going to be talking about grossing up income. So we've all seen these kind of things. We like to do these monthly webinars because I guess I take for granted sometimes I've been underwriting for a long time and like, oh, this seems pretty basic. But we always want to make sure that we're showing all the calculations and how to do it. Now, obviously, Income Expert is a software program. It'll do this for you, but it's still important if you're a loan officer, processor, under auditor to make sure you always have your foundations. So we use these presentations to show like the why behind the what. Why does our system add what it does? How can we follow? What rules are we following when we gross up things? So we like to share, this is not our knowledge. This is owned by the agencies. We share in ours the guidelines, how we calculate it, so that you can have confidence in your calculations and in confidence in Blueprint Income Experts calculations that you use. So some of you clients on here, some of you not. So welcome to everybody. And enough of me yabbering. Let's get what the presentation's about today. So, all right. So we're going to be talking about understanding grossing up income. So first of all, the concept of grossing income, if you think about why we do it, let's just start with the why behind the what. When you have two different borrowers, and I've got Joe who's working a job and he's making $2,000 a month, right? We know that 2 grand is what they're actually making, and then of course we're going to lose our taxes deductions there. So in a typical household or example I give you is like if you think about how the ratios are built, they're built with taxes in mind. So most loan programs don't allow over 45% DTI. Now, of course, I know FHA and VA and them can go up to like 50 something. I get that. But typically speaking, you want to be around the mid 40s on an automated underwrite. So if I make 2 grand a month, so it's saying that at 45% of my gross 2 grand, that's $900 in debt. That would be your house payment, car payment, etc. Now, the reason that they limit to 45 is they also know that outside of the 45%, you've also got living expenses, 30%. You also have taxes. We're talking about federal, FICA, that. Now, obviously, you can see I'm going with a very low income type example here. 24 grand a year working isn't a high wage. Obviously the taxes will get much more extreme. The start making $10,000 a month or $15,000 a month, but percentage wise, it will look about the same. This is where people get more and more expendable income at because the living expenses will open up. But the why behind the what is if we build the ratios, assuming that people have other bills we don't count, like food, insurance, Amazon, going out and getting to Starbucks, whatever, they got money to live on. And, even when they get this paycheck of 2 grand a month, the first 500 they never even see between state, federal, and FICA. So when you think about their money, 45 is a pretty generous number. And this guy's been in the business a long time, and I also volunteer and do some budget coaching for people. I get a little worried when people want a 45% house payment because I'm like, you really shouldn't go over like 25, but you know what? 45 is the standard, and that's what we're gonna do. So that's the kind of the why behind the what there. All right. So now what we have to do is the reason we're going to gross up income is it's unfair if somebody is getting like Social Security, for example. So I got my example here again. I got 2 grand. I can go up to $900. Well, the Social Security person, for this example, really makes 2 grand as well, but there's no way they're paying any taxes. So that, percentage, this 25% roughly, again, I'm just roughing it. It's not exactly why it's called 25%, but they're not paying that. We know they're not. So to even the playing field, we really got to think about them at $2,500 a month, which is a 25% gross up, and their bills can be 1125. If we did it any differently, we would be penalizing them because we would saying, well, you only make two, and we're going to deduct your buying power by another $225 per month because you're going to pay taxes. Well, you're not going to pay taxes, right? So this is how we even the playing field. Because the ratios are inherently built in to handle taxes, when you don't have these tax amounts, we need to remove them from the equation. So now we know why we do grossing up. So now we can get into, how do we gross up? All right, so the different things, pretty common. I know people always think about like pensions or Social Security, but Social Security, child support, some workman's comp, the things you get for your life, they're not taxed. Public assistance, food stamps, not a great source of income, but they're not taxed. Better examples I should put on here are like VA benefits and a couple other things. But the guidelines don't limit you to only certain categories. What they say in all the agencies is, or any other income that can be documented as non-taxable, right? So if you know it's non-taxable, either by federal statute or state statute, or i.e. law, or by a letter, confirming it from a third party like a CPA or the people paying it. Like I've seen foster care income be confirmed by the state as non-taxable, then you can gross it up. Now, the other option is tax returns, right? So that's the more common one. But just so you know, is there any specific, thing you have to get to prove that it's not grossed up or it's not taxed? No, you just need to have a third party reasonable that it is, you can gross it up, right? Simple enough on that. All right, so let's just do the basic one that everybody knows how to do. Child support's an easy one to use for example because I know of, after 31 years in business, I know of no example when child support is ever taxed because the law says whoever's paying the child support. So, for example, if I had to pay child support, I would work, earn money, either self-employed, employed, or whatever. I would pay my taxes, and then I would pay my child support. Alimony used to be a little different than that. So it could, but they flipped that one. But child support's always been the same. I earn my money, pay all my taxes, and then I pay my child support after I pay my taxes. So the person receiving child support never pays taxes on that income because it's already been taxed by the provider. So that's why you can always gross it up. And I've had people say, well, what documentation? I go, I guess you could look up, IRS tax code, but I don't know of any jurisdiction that would tax it. It's always tax free. So simple math, 5 grand, add on 25%, our new income is 6250. Now, if I stop the webinar right here, you'd be mad you even showed up because you'd be like, come on, Mike, that's pretty simple. But this is the easy, simple version in which a lot of them actually are done this way. Let's talk about, again, other methods beside the letter that I've used in underwriting to show something's non-taxable. The most common one you're going to find, because you're going to do it with like Social Security receptions, is the lack of tax returns or tax returns. Okay. The tax returns will show you if something's taxed up. We're going to show you that in a few slides. But if you don't file tax returns, that also proves that you don't. Now, I know some people say, well, there's some people who commit fraud or get behind and don't file tax returns. We're not talking about those people. But if I'm retired and I have no other income beside my basic, maybe a state pension and Social Security, the IRS already knows that about me and it's not taxable. So I don't need to file tax returns because, even if you got a little refund coming, if you don't file for it, they're not going to track you down. So if you have a borrower and all you're qualifying them on is Social Security and it works, let's say a borrower working and a co-borrower not working and all they have is Social Security, well, that way you need taxes if they're married. Scratch that example, not a great one. But if I pull their transcripts and they have no taxes filed and all I'm using is Social Security and I've got evidence it's theirs, that's all you need. That proves it's not taxable because they didn't file any taxes, right? Now, again, I could, after doing this for a long time and doing auditing and fraud investigation, I've seen people monkey around the system. There's no question, but for the most part, that's the way it works. Then the letters from organization. I just gave this quick example of, I had a foster care from a state. I forget what state it was, but I had them confirm that it was non-taxable income, and they did. So I grossed up the foster care income because it met all of the requirements. Third party documentation. Hey, if you can't get something from organization, you can always look up IRS guidelines, have the CPA state it for you, or check a regulation out. So I guess I should put it here. State regulations is probably a better way to say it. But there's also I don't know what you call a state treasury. I call them the IRS too, or the state IRS, but that's not the right term. But there's like federal and state, collection authorities, right? So that's some things you can do. Like, for example, on the child support, again, you can look up in the state of Michigan, where I live, that it is considered tax free by the state and by the federal, right? So easy peasy, you can gross that one up. All right. Now, there's a new rule that it's been out for a few months now. Freddie did it, I think, early last year in 24, Fannie later in 24. And in our calculator, which I'll show you in a moment, people are always like, hey, you got this weird gross up 3.75%. We don't know why you're doing that. It's not anywhere in the guidelines. So, the way that they wrote the rule, it's a little confusing, but if you read the Freddie Mac rule, they give you this example. Now they use 1,000 as the number, I believe, but what they say is you take your Social Security award and by federal statute or IRS regulation, however you want to say it, 15% of your Social Security is never subject to tax. Now, if you're not aware about Social Security, if you start getting Social Security, whether you're 62 or 65 or whatever, and you earn money, they will tax a portion of that. Now, I don't know the exact ratio. I forget. It's like 2 to 1. In other words, if you make like 40 grand, like 20% of your Social Security can be taxed. And that's reflected on the tax return. It shows you the ratios. But that last 15% is never taxed. I could make $1 million a year, collect my Social Security at age 65. That last 15% would not be taxed. So what they're saying is take the 5 grand times that 15% non-taxable, that's $750. Now you can gross up that non-taxable amount by 25%. That is $187.50. So you take your 5 grand award, add on your non-taxable amount, your gross up amount, and now you got 5187.50. But there's a shortcut. All right. A lot of extra math, more math means more errors. What we did in our system is we just kind of thought about how do we get the same end result? Well, if you take $5,000 times 3.75, you get the same 187.50. So that's what we do. So instead of a bunch of multiple steps, which could create confusion, we just go right from the award letter down to that. So that's that newer, like it's about under a year old, where Fannie and Freddie are both like, hey, you don't need to document this. If you do this formula, you will get approved because we know by IRS regulation, statute, whatever, that you're not being taxed in that last 15%. So we created the shortcut in our system. All right. Now I've been talking to you that tax returns will also show if things are taxable or not taxable. So when you look at the front of a 1040, this is the first page, you can see these center columns. It's a little different for, I think it's dividends. Don't worry about that one. But the other one's interest, IRA, pension, Social Security. What happens is the box you see on the left is a reference box. Everything on the right is a tax box. So the way it works is if I've got $24,000 a year coming in for Social Security, I would say 24 here. Now over here, it will say 10 or 20, or it will never exceed what's in 6A. That's impossible. But it'll say, the amount that I got taxed. So if I have 24 in the left and 12 in the right, what that tells me is half of what I'm earning is taxed. Some people think you're getting 24 plus 12. That is not correct. You're not making 36 grand. It's just you're being taxed on half of what you make. And that's how all these boxes are set up. The center is the reference, the right's the tax box. That's why it's in the column over here for your taxable income. So if I were to do the math on that, so I look on my calculator or look on my tax form, I see I've got 24 grand, and then I'm going to subtract my taxable amount, 10 grand. And then it basically, oh, I got that wrong. I should say 6B, my fault there, a little typo. And then I would have, 14,000. That's the non-taxable amount. I would gross it up 25% gives me 3,500 for the year. I add that back to what I received in entirety. That's 27,500. I divide it by 12, 22,967. No further documentation is needed because the tax returns become your source of evidence of the non-taxable income. So that's why we do it in our calculator that way. So we handle all those calculations for you, but you can see it's not complex. You just got to pay attention. Now, I will say, and I should have created a slide for this, what you'll see often too is that there'll be nothing in the left box and only a number in the right box. Per the IRS regulations, if you are taxed at all of your income, which I don't understand, again, based on that 15% rule. So it's a little weird, but because I see it so much and I'm not a CPA, I'm just going to tell you what I see. If I just see 24 grand over here and nothing over in 6A, that means that everything they receive from the Social Security was taxable. Not sure how that's possible with 15% rule, but I'm no CPA. I'm not going to tell how people have to file their taxes. I mean, I've looked at tens of thousands of tax returns, but I'm not a CPA. I just know how to read them. I don't know how to develop them. But if you do see that situation, everything's in the right-hand side and nothing's in the 6A, that means it is 100% taxed. And I would still follow that 15% rule because, I mean, the agencies say you can do it. So why not, right? I really think there's some kind of CPA laziness. If you ask me what's going on there, I'm not exactly sure. All right. Well, that was a few examples, but I also want to pull up our calculator and show you how we do it in here. In the slide I put up here before I switch to the calculator, hey, if you like our underwriting training, this is a system I developed. I've been training underwriters now for 25 years, underwriters, processors, and this is our field guide. I mention it from time to time in these webinars. Here's how we or I have learned over the years. The people that taught me to underwrite in the 1990s when I started, they laid this plan out for me, and my brain's a bit ADD, so I need a nice racetrack to go on. But they showed me how to break down a file very effectively and efficiently, and that's what this slide is. And we share the slides after the presentation. But you read the story, get your guidelines, get it right, review your credit, get your debts in line, figure out your income. That's what income experts all about, the income, step 4. Then you do your assets. Then you do everything about your property, your condo docs, your appraisal, your title work. Do your miscellaneous steps, HELOCs, condo rules, secondary, jumbo rules, whatever. Do your fraud review, run the AUS, update your conditions, pick up the next loan, move on. So this is our field guide to underwriting. Now we generally focus all of our underwriting training in this area here. But if we do have a few presentations, if you're one of our enterprise or teams clients, reach out to me. We can always help out on top of these monthly webinars. It's included with your enterprise package and a discount for teams. All right, let me show you, pull up our calculator and share a few more things with you here. F11. Okay, so what I've done is I've logged in case you're not one of our clients. You get our income calculator. This is our system. So it's basically a 4-step borrower income REO report. So what I did is I went through and pulled out some of the examples of places you'll find gross up. Now, the way our system's set up is when you want to add income, you can, pick the income you need. Now, there's a few more examples in here that you can gross up, but I'm just kind of leaving it. I kind of made the point with as many as I have here. All right, so I'm going to show you the different things we've done, and it goes along with the training. Like I mentioned at the beginning of this training, we always like to explain why we do what we do. So what are we doing grossing up? Why do we do it? We talk about the rules, the why it's done, and then we're going to show you the how, and I'm going to show you how the calculator takes that how even further and does it for you. All right, so I go to income, and I want to look at my U.S. Army military pay. And if you're in the Army full-time or even reserves, you might get well, you won't get $50,000 a month base pay. That's nobody in the Army makes that kind of money. But they make $5,000 on their base pay, but they get BAS, which is substance, another word for food. Sometimes it'll say BAF, but I always generally say BAS, BAH, housing, basic allowance for housing. And these are non-taxable. So my base pay is taxable, but my housing and my allowance are not. So when we hit save calculate, we automatically add on the base pay plus your we take your gross up your amounts, the 25%. That means your qualified income is 5,250. And of course, there's other ones in here, COLA, and that are non-taxable. Okay. So that's one example. Social Security income. Now, this is the one where you're checking the tax return. You can see our system makes it simple. I have an award letter, or I just want to use tax returns. Matter of fact, I'll just use tax returns. The tax returns say I got 20 grand in the middle. I got 10 grand in that right-hand column. I do want to gross it up. 25% is my Fannie Mae rule. Save calculate. 1875 is my number. And you can see our math is all broke down in there. So we show what we did, how the math worked out. So your team will never have to go, hey, Mike, did you gross that up? And of course, the great thing here is we talk about confirm it's non-taxable, which is done by tax return. So you just confirm that there. Another example, pensions. Same kind of line. You get an award letter, tax return, whatever you want to do. If you want to say you got a monthly award letter from the Crane Operators Union of Michigan, and you get $4,000 a month from them. Now, I like to pick on them a little bit. My dad is a retired diesel mechanic, so he gets the same pension. You gross it up, and I put in my 25% for my agency guideline, and that means I know it's non-taxable, so I get the $5,000 amount, and of course, I'm required to confirm it. The child support, that one's the easy, always, child support is always non-taxable. You can see we default to that when you come in. You can always gross it up, so we allow it there. And we have a general calculator. If you have some other random kind of maybe VA benefits or something, and they're $500 a month and they're non-taxable, you can do that and put in a description about what it is. And my last example is that gross up rate with Social Security. If I get that $5,000 award letter, there's my cheat code, my 375, the one that we get some support tickets on. But if you click this little help button, we'll kind of explain to you like, hey, what we're doing and why we're doing it. So oops, let me get out of there. Should not hit that button there. Okay, here we go. F11. All right, and we explain why we're doing it. Anyway, so it automatically adds that 3.75. There's the 187.50, and there's our 5187.50 per year. And of course, you can see it doesn't say, hey, document it. It's just, hey, just make sure it's got 36 months, which if you're retired, you get it. Now, if this was like some kind of award because of a death of a spouse or temporary or for a child, of course, there would be limited time there. But that's some examples in our income expert software. Again, most people come to our webinar are already clients, not trying to sell you on that, but we just want to let you know, again, what we do, why we do it, how our calculator executes it. So that way, when you get your income report that is accurate, compliant, fast, well used, run 3.2 million loans right now, well documented income, you can rest assured that whether you're doing a Fannie, Freddie, FHA, VA, USDA, you're going to get the right income. So